Welcome back, everybody, to Volatility Trading Strategies. So of course, there's many different ways to invest and many different time frames to focus on. But just to set the table here for today's video, allow me to reduce the investing world into two very simple categories. On the one side, we have all the variations of buy and hold. And on the other side, we have tactical investing. Now, you don't have to have seen very many of my videos to have heard me say that I am entirely on the tactical investing side. But I do get many follow-up emails asking me just what do I mean by that. So today, I'm going to go over a real-world example to show you exactly what I'm talking about. And as always, I make the videos and you smash that like button for the YouTube algorithm. It just takes a second, but it really does help me out a ton. So do that now, and let's talk about tactical investing. So just let me define the terms here before I show you a real example. Your standard buy and hold portfolio is going to consist of multiple different asset classes. So depending on how complicated they want to make it, it may include both domestic and international stocks, bond funds of various duration, some precious metals and some real estate exposure, maybe even some crypto. These are all held at the same time in various allocation sizes. And then it's basically assumed that it will be diversified enough to weather market crashes when they happen. And because of slick marketing techniques, many investors are made to believe that that portfolio will actually work. Now, in the real world, it just doesn't, because when markets crash, many of those assets are highly correlated to one another. So even though it sounds like a diversified portfolio with many different asset classes included, correlations are so high during a market crash that the whole portfolio goes down in flames anyway. Now, from the asset manager's perspective, it's awesome. They just allocate your money when you sign up with them, maybe do a once or twice a year rebalancing that takes a couple of hours, and then they just sit back and collect a percentage of your assets. It's great. The investor's long-term rate of return will barely outpace inflation, but the financial industry itself will continue to thrive. That's the world of buy and hold investing. Now, on the other side is tactical investing. And tactical investing, simply put, is actively rotating in and out of positions based on current market conditions. So this is the performance of the Vanguard VBINX since January 2012. The VBINX is a 60% stocks, 40% bonds balanced index fund. And as far as buy and hold investing goes, this simple index fund will beat about 90% of those silly, complicated pie charts you've seen. And just for reference, I can include the HFRI Hedge Fund Index on here as well. So during this latest long bull market, the VBINX has achieved about an 8.99% annual return. Now that's actually pretty decent if it stays this way long term. But during the last recession, for example, the Vanguard VBINX suffered a 38% drawdown that took over 3 years to get back to the break-even point. And with interest rates at zero these days, and all the economic problems the world faces, I think it's perfectly reasonable to assume that this could easily happen again, and probably even worse the next time around. So when the next crash happens, the long-term rate of return when factoring in both a bull market and a bear market, it could easily drop down to low single digits, much more in line with long-term expectations. Tactical investing, the way I do it here at VTS, is to rotate in and out of different asset classes, to reduce drawdowns, and to bypass this whole bull market, bear market nonsense in the first place. The way I see it, why do investors have to accept that their portfolio is going to crash 30 or 40% in the next recession? It doesn't make any sense to invest that way. We all know it's coming, and it's going to be no surprise to anybody when it does, so perhaps we should be a little bit more proactive and do something about it before the next crash. This is the performance of my entirely tactical Total Portfolio Solution since I launched in January 2012. It's made up of several different independently traded tactical rotation strategies that all combined into a diversified portfolio. Now, currently we're 20% each to 5 different strategies, but that's also tactical and can change with the markets. But looking past the obvious and substantial improvement in long-term performance, the most important aspect of my tactical investing by far is how these results happened over time. You'll notice that during every single market crash of over 10% since I launched, my portfolio has done just fine during those periods. That's the key to success long-term. Any buy and hold investor can perform well when the markets cooperate. A blindfolded monkey throwing darts at the S&P 500 can do that. But only tactical rotation strategies can avoid those crashes that are inevitable. That's why I do it. It's not to crush the S&P 500 during good times. It's to not crash with it during bad times. That's the key to multi-decade long success. So here's one of our 5 tactical rotation strategies. I call it the tactical balanced. And this strategy rotates between 3 potential holdings depending on market conditions. During low risk periods, we hold the MDY, which is the S&P 400 mid-cap ETF. And long term, this has occurred on about 55% of trading days. During medium risk periods, we hold the IEF, which is 7 to 10-year US Treasuries. Historically, this is on about 30% of trading days. And then during high risk periods, the remaining roughly 15% of trading days, we hold the GLD, which is an ETF that tracks gold. So we're not holding all 3 of these at the same time and just crossing our fingers hoping correlations hold up in a downturn. Instead, we're tactically holding only the single position that has the highest probability of success given current market conditions. Now for me, my work specializes in volatility, so that includes trading options and volatility ETPs directly, as well as trading traditional asset classes like stocks, bonds, and gold. I view it all through the lens of volatility, so even if I am trading just stocks and bonds, for example, I still consider that volatility-based trading. I feel that tracking volatility metrics is by far the best way to gauge the risk level in the market, and every trade I take is based on careful analysis of dozens of volatility metrics. And then depending on the composition of those metrics, we tactically position the portfolio accordingly. So let me show you how this tactical rotation works by using the tactical balance strategy since just January 2018. Because in the last 3 years, we've seen 3 significant market crashes that investors would definitely want to have avoided. The February 2018 Volpocalypse event, the Q4 2018 crash, and of course the global pandemic of 2020. Remember, the bulk of the performance of my tactical balance strategy does come from when we're holding the S&P 400 mid-cap ETF. Over 55% of the time, we're holding this MDY, and you can see how it's performed since January 2018, a compound annual growth rate of just 2.36% in the last 3 years, with several large drawdowns, the biggest being a drop of over 42% during the pandemic. Buy and hold the S&P 400 would not have been very much fun in the last 3 years. But with tactical investing, we're moving out of stocks completely during those high-risk periods and moving into bonds and gold instead. As a result, we can substantially improve the performance, from 2.36% a year buy and hold to almost 13% a year tactically, and most importantly, a massive reduction in stress. The maximum drawdown of the tactical balance strategy in the last 3 years is just 7.7%. Given how crazy the markets have been, that is well within the risk tolerance level of virtually any investor of any age. Now, I don't want to talk about it that much at all here, but it is worth a quick mention. We do also have a leveraged version of the tactical balance strategy for investors with higher risk tolerance. The signals are completely identical to the base strategy, we just make a few substitutions to take on a little more risk. And since January 2018, the leveraged tactical balanced returned 26.6% a year, which is 11 times more than the MDY buy and hold on its own. As we would expect, the risk does increase a little bit since it's leveraged, but it was still a very manageable maximum drawdown of 11.5%. So 11 times the return of the base MDY with 1/4 the maximum drawdown. It's been pretty solid during these troubled times. So on one side, we've got buy and hold investing, which unfortunately the vast majority of the investing world is doing. During bull markets, it's fine. It's smiles and high fives all around. Everybody's happy. But when the markets crash, and they will, buy and hold investors are going to quickly and painfully realize how non-diversified they really were. Long term, they can expect to make a low single-digit rate of return. Or perhaps it's time to embrace a little out-of-the-box thinking and some tactical investing. It's not magic. I'm just using a multitude of volatility metrics to gauge the pulse of the market day to day, and then completely rotating out of all risky positions when we start to see some red flags. The best way to avoid portfolio drawdowns when the market is crashing is to not be in those risky positions to begin with. So you're not going to want to miss part 2 of this video series, where I'm going to actually show you the daily trade signal emails that went out to all our subscribers during the 3 largest crashes of the last 3 years. I'll show you exactly what my tactical investing is all about, so stay tuned for that one for sure. And as always, there is a free trial on my website if you want to check out my work. No hurry, of course, I will be here for years, no pressure, but if you do want to do that, claim your free trial on the website and take a quick peek. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.